Worth a staggering $45 trillion and encompassing over 140 million housing units, the U.S. housing market is not just the biggest, but also the most crucial market in the world. But what if we told you that this mammoth market is teetering on the brink of disaster? With the potential to send shockwaves throughout the global economy, the consequences would be monumental. The foundations of this colossal market are starting to crack, and its impending collapse could reverberate across the globe. Join us as we uncover the hidden dangers lurking within the U.S. housing market and explore the far-reaching consequences of its potential implosion. In recent years, the U.S. housing market has experienced unprecedented growth, with home prices reaching record highs in many cities. A combination of interest rate fluctuations, limited housing inventory, and high demand has fueled this surge, leaving experts and potential homebuyers wondering if a major correction is on the horizon. In fact, some cities have already witnessed price drops of up to 25%, hinting at the possibility that the market could be heading towards a collapse similar to the 2008 financial crisis. This looming crisis has become a critical topic of discussion in the financial world, as the consequences of a housing market collapse could have far-reaching implications for the broader economy. With mortgage rates fluctuating, home prices in some regions remaining stubbornly high, and the possibility of a nationwide crash growing increasingly plausible, it's crucial for investors, homebuyers, and policymakers alike to understand forces driving the U.S. housing market towards this potential implosion. The U.S. housing market has experienced a remarkable boom in recent years, with skyrocketing prices, record low interest rates, and limited housing inventory. Many cities have seen double-digit price increases fueled by a surge in demand and an influx of investors snapping up properties. However, there are growing concerns that these factors have created a housing bubble that's on the verge of bursting. Several warning signs indicate that the housing market is headed for a major downturn. For starters, the National Case-Shiller Index has reported 6 straight months of decline, a trend we haven't seen since 1987. Additionally, cities like Seattle have experienced price drops of more than 15%, a figure reminiscent of the 2008 financial crisis. Meanwhile, the Federal Reserve has begun raising interest rates, making it more expensive to borrow, which reduces demand for homes. One key factor contributing to the potential housing market implosion is the increased presence of investors. As institutional investors and wealthy individuals buy properties, they are driving up prices and reducing the availability of affordable homes for regular buyers. This influx of investment capital has made it difficult for first-time homebuyers and those with lower incomes to compete, leading to a growing affordability crisis. Now, the COVID-19 pandemic is somewhat behind us, but it has had a profound impact on the way we work, with many companies adopting remote work policies. This shift has led to an increased demand for larger homes and remote work-friendly spaces, adding even more pressure to the already competitive housing market. As remote work becomes more prevalent, demand for housing in suburban and rural areas may continue to rise, further straining the market. Add to this the fact that as housing prices continue to soar, the risk of a widespread affordability crisis is growing. Wages have not kept pace with the rapid increase in home prices, and the recent interest rate hikes only exacerbate the problem. The widening gap between income and housing costs could lead to a significant reduction in demand, resulting in a sharp decline in housing prices and potentially triggering a market implosion. So when you see millennials and Gen Z expressing their frustration on the internet, they aren't wrong. The housing prices are actually out of their reach, and as already mentioned, the increase in interest rates is making things worse. In a mere 6 months, the market has lost a whopping $2.3 trillion in value, leaving homeowners feeling the pinch. But what's behind this unprecedented downturn? And what does the future hold? Well, according to Redfin, this is the largest drop since the infamous subprime mortgage crisis of 2008. This time, the culprit is the higher interest rates, which have driven down demand and caused median home prices to plummet by 11.5% from their peak in May. And unfortunately, the pain doesn't stop there. With borrowing costs on the rise, potential homebuyers are being left on the sidelines, causing U.S. home purchase applications to hit a 28-year low. The hardest hit areas include cities like San Francisco, Oakland, and New York, where the pandemic caused technology layoffs and soaring prices. Redfin economist Shen Zhao says that despite the current downturn, most homeowners will still benefit from the pandemic housing boom, with the total value of homes remaining about $13 trillion higher than before the pandemic. However, the prices are expected to continue falling. Pantheon macroeconomist Kieran Clancy predicts decline in prices following the collapse in existing home sales, which have dropped nearly 40% from their pandemic peak. Pantheon ultimately projects that home prices will fall by around 20% from their peak by the end of this year, potentially causing the median price to tumble another 10% to about $346,500. On the other hand, Comerica Economics foresee more modest price drops, with average prices potentially decreasing by up to 9% on a national basis. The recent downturn in the U.S. housing market is a stark reminder of the market's vulnerability to external factors such as interest rates and economic policies. As homeowners, buyers, and sellers navigate this uncertain landscape, it's crucial to stay informed and prepared for the potential challenges ahead. Now that there are some clear signs indicating the possibility of an implosion in the housing market, let's go through the potential consequences of a housing collapse. Number 1. Widespread negative equity and foreclosure surge. If the housing market collapses, one of the most immediate and visible consequences will be a widespread increase in negative equity, where homeowners owe more on their mortgages than the current value of their properties. As home prices plummet, those who bought at the height of the market will be hit the hardest, leaving them trapped in properties that are no longer worth their initial investment. This could lead to a surge in foreclosures, as homeowners struggle to keep up with mortgage payments on homes that are underwater. The wave of foreclosures would result in even more distressed properties on the market, causing a vicious cycle that further depresses home values and exacerbates the housing crisis. Number 2. Broader economic downturn. A housing market collapse can have a far-reaching effect on the broader economy, as it can lead to a significant reduction in consumer spending and confidence. As home values drop, households may feel less wealthy and become more cautious with their spending, impacting various industries such as retail, automotive, and travel. Additionally, the construction sector, which is heavily reliant on a healthy housing market, could face massive job losses and reduced investments in new projects. The financial sector would also suffer as banks and lending institutions deal with a growing number of delinquent loans and tighter credit conditions. This domino effect could potentially plunge the economy into a recession, further straining the job market and amplifying the financial distress experienced by households. Number 3. Long-term social and geographical consequences. The fallout from a housing market collapse can also result in long-term social and geographical consequences. As affordable housing becomes increasingly scarce, many people may be forced to move away from high-priced urban areas in search of more affordable options. This could lead to a significant shift in population distribution, with cities experiencing depopulation and rural areas seeing an influx of new residents. Such population shifts can strain local infrastructure and resources, affecting the quality of public services such as education, healthcare, and transportation. Additionally, the collapse may exacerbate existing wealth and income disparities, as those with lower incomes are disproportionately affected by the lack of affordable housing and may find it increasingly difficult to secure stable, well-paying jobs in a weakened economy. With such dire and far-reaching consequences, as the U.S. housing market shows signs of an impending implosion, it's crucial for potential home buyers, investors, and policymakers to be vigilant and prepared. After all, nobody wants to see the frightening images of the 2008 housing market collapse. Well, it was the time when houses were selling like hotcakes, people were getting loans without a second thought, and the economy seemed unstoppable. But then, without warning, it all came crashing down. This is the story of the 2008 housing crisis, a financial disaster that shook the world and left millions struggling in its wake. The story of the 2008 housing crisis began with a boom. In the early 2000s, the U.S. housing market was experiencing rapid growth fueled by low interest rates, lax lending standards, and a sense of optimism that home prices would continue to rise indefinitely. As a result, people were buying and selling homes at a record pace, driving up prices and creating a bubble that seemed too good to be true. And it was. At the heart of the housing crisis was the subprime mortgage market. In an effort to capitalize on the booming housing market, lenders began offering mortgages to borrowers with less than stellar credit, known as subprime borrowers. Many of these loans came with adjustable interest rates that started low, but could skyrocket after a few years, making it difficult for borrowers to keep up with their payments. As more and more subprime loans were bundled and sold as mortgage-backed securities, the stage was set for disaster. The first cracks in the housing market began to appear in 2007, when borrowers started defaulting on their subprime loans. As the number of foreclosures began to rise, panic set in. investors started to question the value of the mortgage-backed securities they had bought, causing their prices to plummet. This domino effect rippled through the entire financial system, leading to the collapse of major banks and financial institutions, such as Lehman Brothers and Bear Stearns. The stock market tumbled and the U.S. economy plunged into a deep recession. As the crisis deepened, the U.S. government intervened, bailing out struggling banks and financial institutions with billions of dollars in taxpayer money. This controversial move was seen as necessary to prevent the entire financial system from collapsing, but it also led to widespread public outrage. Meanwhile, millions of Americans lost their homes, their jobs, and their savings as the economy crumbled around them. In short, the 2008 housing crisis had far-reaching consequences, both in the U.S. and around the world. In the years that followed, new regulations and reforms were implemented to prevent a similar crisis from happening again. Stricter lending standards were put in place, and the financial industry faced increased scrutiny and oversight. Despite these changes, the scars of the 2008 housing crisis remain, serving as a stark reminder of the dangers of unchecked greed and speculation. Now the question is, are we heading in the same direction? Well, things seemed almost identical to 2008 just a couple of months ago. However, it seems that appropriate corrective measures are being taken at the policy level to avoid such a crisis. Banks were at the center stage of the 2008 crisis, and with recent news of Silicon Valley Bank collapsing, there is quite a lot of resentment and apprehension among the investors. It would not be wrong to say that the sudden collapse of Silicon Valley Bank has sent shockwaves throughout the real estate industry, leaving builders and agents scrambling to understand its implications for mortgage rates and the economy. Real estate marketplace Zillow's chief economist Skylar Olson has made a couple of predictions on how the bank's collapse could impact the U.S. housing market in 2023 and what it means for both buyers and sellers. One possible outcome of Silicon Valley Bank's collapse is a drop in mortgage rates. If the Federal Reserve refrains from future rate hikes, which seemed imminent just weeks ago, we could see mortgage rates fall even further. Financial markets have already pushed the average 30-year fixed mortgage rate to 6.75%, down from last week's peak of 7.05%. A sustained drop in rates would be a welcome relief for home buyers, especially in high-priced areas. However, if the bank's collapse signals an impending recession, the benefits of lower mortgage rates could be overshadowed by the economic turmoil. Another potential impact of Silicon Valley Bank's collapse is the increased strain on tech-dominated housing markets like San Francisco, Boise, and Seattle. These high-cost markets have already been heavily affected by the Fed's ongoing inflation fight, and the bank's collapse could exacerbate existing challenges. If a widespread tech downturn occurs, housing markets reliant on tech employment and stock prices could see chilling effects and falling prices as fewer buyers can afford the elevated costs. For buyers and sellers in tech hub markets and across the U.S., the coming months are likely to be challenging. While lower mortgage rates may provide short-term affordability boosts, the longer-term risks associated with wider economic issues cannot be ignored. Buyers should focus on finding homes they intend to keep for several years, allowing time to build equity in case of market turbulence. Clearly, with uncertainty looming, staying informed and making well-considered decisions will be crucial in weathering the storm of the housing market's future. But wait, there is more to the picture than meets the eye, and while there has been plenty of bad news and everything may look dark and gloomy, there are a few signs indicating that despite all the risks, we may just avoid the housing market crash. So let's take a look at a few of the positives. There are several key factors that suggest the current housing market is more stable and resilient than it was before the last crash. So let's explore the reasons we may not see a repeat of the 2008 financial crisis. Number 1. Stronger lending practices and regulations. One of the main reasons for the 2008 housing market crash was the prevalence of subprime mortgages and lax lending practices. Today, lending institutions have implemented much stronger regulations and underwriting standards, making it more difficult for unqualified buyers to obtain mortgages. Borrowers are now required to have better credit scores, provide higher down payments, and fully document their income and assets. These improved lending practices help to ensure that homeowners can afford their mortgage payments, reducing the likelihood of widespread defaults and foreclosures. Number 2. Low housing inventory. Another factor contributing to the stability of the current housing market is the low inventory of available homes for sale. Unlike the period leading up to the 2008 crash, there is not an oversupply of homes on the market. In fact, demand for housing currently outpaces supply, resulting in increased home prices and a competitive market. This tight inventory helps to support home values and reduces the risk of a sudden crash in prices. Number 3. Low mortgage rates. Mortgage rates have remained historically low for an extended period, making it more affordable for potential buyers to purchase homes. Low mortgage rates translate to lower monthly payments, enabling more people to enter the housing market and maintain their mortgage payments. This increased affordability helps to support the housing market and reduces the risk of a crash caused by widespread defaults. Number 4. Strong job market and economic growth. The strength of the overall economy and job market is another important factor contributing to the stability of the housing market. With low unemployment rates and steady economic growth, people are more likely to have stable incomes, making it easier for them to afford mortgage payments and reducing the risk of default. A strong job market also encourages new household formation, which in turn drives demand for housing. Number 5. Diverse and resilient local markets. The U.S. housing market is made up of many diverse local markets, each with its own unique characteristics and trends. While some areas may experience price fluctuations or localized downturns, the overall housing market is more resilient than it was before the 2008 crash. Many cities and regions have strong local economies, job growth, and population growth, which help to support their housing markets and mitigate the risk of a nationwide crash. So while there is always a degree of uncertainty in the housing market, the current conditions suggest that we are not on the verge of another crash like the one experienced in 2008. Stronger lending practices, low housing inventory, low mortgage rates, a strong job market, and the diversity of local markets all contribute to the stability and resilience of the U.S. housing market. While it's important to remain vigilant and monitor market trends, there are several reasons to believe that the housing market is not about to implode. Having said that, we are not out of the danger zone just yet. There is still a significant risk of a similar domino effect happening as the one in 2008. The next few months will be crucial. It is a very delicate time for the investors, builders, and home buyers.